couple of quick addendums to Chapter 6. First up is just some reconciliation items when you're doing your year-end inventory count. There's 4 things you should be conscious of including and 4 of excluding. You'll notice most of the excluding take care of themselves, so there's really not much to it. So first up, FOB destination sales night received by the buyer at year end. So the idea here is, again, goods were shipped December 31st, delivered to the buyer on January 3rd. Therefore, they were included in the seller's inventory because they were legally owned in transit by the seller corporation. So that's the key thing here. Because you had legal ownership, therefore we consider it to be something you should count. Oh, mouse is not my friend right now. There. So as a consequence of that, it needs to be included in inventory, again, if we're going to be letter of the law. But in reality, what we do is we let companies who have insignificant amounts of these types of sales, we don't care. In other words, materiality is going to dictate, don't worry about it. But if it's material, so for example, if we had like $50,000 out of $10 million in sales, we go, well, that's too small. It's not material. What if it was $1 million out of 10 million? There was like a big sale happened right at the end of the year. In that case, we would say that's material, and we would do what? We would make the timing of the sale and the cost of the sale all happen on the moment that they were delivered to the buyer. We would say at that point, that's when everything culminated, therefore, that's when those would be booked in the next period. But that's only if it's material. Now, in the case of the next one, FOB shipping point purchases if given to the shipper by year end. So in this case, the goods were shipped by the seller December 31st. Therefore, they're included in the buyer's inventory because why? They were legally owned in transit by the buyer corporation. So in this case, there's no exceptions. We don't look at materiality. We just say, guess what? You'll eventually get it, probably in early January. So what do? Backdate the point of acquisition to when they were shipped, and then count it and include it in your year-end count. So simple as that. Next up is something you might not be familiar with, but it's the concept of a consignment. So what is consignment? So the idea here is consignments of corporations and merchandise to other businesses. And what you're doing is it's inventory you own, you're not selling it, you're just giving it to another company because you're doing a really poor job at selling this inventory. That's the bottom line here. So you're finding somebody else who's doing a good job, and you strike up a bargain with them, such as, okay, I'll give you 10% of the gross for everything you sell. Remember, the company you're giving it to doesn't have any money in this stuff. They got nothing. They're just taking possession of it and selling it for you. So they might be happy with that because that's 10% of, it's pure profit to them. Now, in this case, you're in the situation where you're the consigner. So if you're the consigner, the one consigning goods to somebody else, those unsold portions should be inventoried on site and included in your year-end count. Because why? You still legally own them. The company that you gave them to doesn't own anything. They've just taken physical possession of it. That's it. And then fourth on the list here is return merchandise. So you get something back. Doesn't matter if it's defective or just, they have the right to return it. Even if you intend to return those defective goods and get a refund, or fill a replacement order, it doesn't matter. You're the legal owners of this stuff, so therefore it must be included in your year-end count. All right, again, that's the included. A little more to talk about there. Excluded, most of these kind of take care of themselves. Like FOB destination purchases haven't been received by year-end. In this case, it was shipped December 31st, but you don't get it until Jan 4. Guess what? You took legal possession of it on that day, therefore you wouldn't include it in the previous year's count. So it's kind of a situation where it's not there to count in December, don't count it. Next up is FOB shipping point sales, which tends to be a lot of sales if given to the shipper by year end. So again, you gave these goods to the shipper on December 30th, therefore they're excluded from the seller/corporation's books. And again, the customer owns the goods in transit, so this is one where you say, well, we get to our year-end count. It's not there to count, so don't count it. So that's another one that takes care of itself. Now this number 3 here is consignments of merchandise to our corporation. So now we're in the position of the consignee. So in this case, you own nothing, you take possession of it, and you have a duty to, of due care that goes along with that. And of course, the thing you should be aware of here is making sure that those goods are separated from other merchandise to avoid potential confusion. And lastly, here we have merchandise on hand for warranty work. Customer is the one that owns the goods, and the corporation is just an intermediary for either performance of repair work, or which could be sometimes on-site or contracted elsewhere. So in that case, again, they don't own it, the customer does. So really, of these 4 that we're looking at, this is the only one maybe you have to be aware of, really, is if you get consignments of goods, make sure that you separate those goods from yours so that they don't accidentally get, included in your count. That's really the only one you got to concern yourself with. And the last little tag along here is the idea of lower cost to market inventory valuation. So most conservative valuation of inventory that you're going to see, what we're going to do here is we're going to write down our goods if purchase price falls below market, which we define as replacement cost. Now, replacement cost means what? To get the same thing in the same condition back. Like, what would it cost you to get that same thing in that same condition? Cost to replace it. So in this case, we have 5 commodities on our hands, W, X, Y, Z, and sigma. So I thought I'd throw a little Greek notation at you there. So in this case, it's really very simple. Now there's 2 ways we're going to primarily look at it. There's 3 possible ways of handling it here. We can do lower of cost or market by item, which is the one we're going to focus on mostly. We can do it by total, which is one we'll look at briefly, and you'll see why. And there's a third possibility by category, which I didn't apply here, and that's probably the rarest of the bunch here. Now, if you're really looking to write down inventory, you're going to do it by item, because if you do it in any other method, there's a chance you would write nothing down, as you'll observe in a moment. So we're going to look at each one of these commodities, and we're just simply going to do what? Take units times costs and market. So I got 2 columns set up for that right here. And it's very simple. We're just going to pick the smaller of the 2. That's it. That's all you got to do. Pick the smaller of the 2. So for the W, we got 25 units that we paid 100 for, but market now is only 95. Again, only $95 to replace it. So cost is 2,500, market's 2,375. So in this case, we'll go with market. That's something we're going to be writing down then. That's one of the ones we'll be writing down. Commodity X, 70 units, paid 55, market 65. Total cost $38.50 versus $45.50. Again, for that one, we will stick with our cost in that case, because again, it's the smaller number. Commodity Y was 55 at 28, but only 20 to replace. So our cost is $15.40, but market's $1,100, so that's one we'll be writing down as well. So we'll be writing down the Y. The Z is 98.85 cost, 92 to replace. So again, $76.50 is our cost, $180 is market, so that's when we'll stick with cost. And then lastly, our sigma is 20 at 120 is what we paid for it. Only 100 to replace right now. So 2,400 we paid, 2,000 to replace. So this is another one we'll write down. So we're going to with the $2,000 figure there. So there's 3 of these we're going to end up writing down. We'll write down the W, the Y, and the sigma. So those 3 get written down. So when you total up the new inventory value here, which is just the total of this column right there, you'll get $16,975. And again, the cost of those items was $17,940. So as a consequence of that, if you do it by item, you'll be writing this down $965, just the difference between those 2 numbers. Now, what if we were doing total market versus total cost? Well, total market is $18,305, whereas total cost is $17,940, excuse me. So that's when in this case we would just stick with cost. In other words, it's unlikely you're going to have write-downs if you do total versus total. And here's the thing you got to keep in mind. Any analysis means you still have to do it by item anyways. So if you're intent on writing something down, you might as well analyze it by item, because that's really the only way you're going to get a write-down, and you have to do that work anyways. So what is the journal entry that you would have to book as a consequence of this? It would be right here, cost of goods sold debit, merchandise inventory, credit for $965. So in other words, that means this will be the new booked value for your inventory, $16,975. All right, and that concludes Chapter 6. So look for more videos from here on out. Bye.